Have you ever seen a stock that just keeps going up and you think, this is it? This is the one that's going to the moon and never coming back. We've all felt that FOMO, that fear of missing out, as a company's valuation seems to defy all logic. It feels like you're watching a rocket launch and you're just standing on the ground. But what if I told you that even the highest flying rockets eventually have to deal with a fundamental, inescapable force? That force is gravity. And in the world of finance, market gravity always wins. Welcome back to the channel. Today, we're diving into one of the most crucial concepts for any long-term investor, the idea that market valuations, no matter how inflated they get, will eventually return to their fundamental value. It's not a matter of asterisk if asterisk, but asterisk when asterisk. Understanding this principle can save you from costly mistakes and help you build sustainable wealth. So, what exactly is market gravity? Think of it like this. A company's true, intrinsic value is its center of gravity. This value is based on concrete factors: its earnings, its cash flow, the strength of its balance sheet, its competitive advantages, and its future growth prospects. It's the real, tangible business underneath the stock ticker. The stock price, on the other hand, is like a balloon tied to that center of gravity. Sometimes, due to market hype, exciting news, or pure speculation, that balloon can soar high above its anchor. This is what we see during market bubbles. Everyone gets excited, sentiment is euphoric, and prices get detached from reality. People start believing this time is different. They create new metrics to justify sky-high valuations, ignoring the old, boring ones like price-to-earnings ratios. The dot-com bubble in the late 90s is a classic example. Companies with no profits, sometimes not even any revenue, were valued at billions of dollars simply because they had .com in their name. The balloon was floating in the stratosphere. But gravity is patient. Eventually, the hype fades. The hot air starts to leak out of the balloon. Maybe a company misses an earnings report. Maybe a competitor emerges. Maybe the broader economy slows down. Whatever the reason, investors start to look at the fundamentals again. They start asking the tough questions. Is this company actually making money? Can it sustain this growth? And as that reality sets in, the stock price begins its inevitable descent back towards its intrinsic value. The string pulls taut and gravity does its job. The dot-com bust was brutal, wiping out trillions in market value and teaching a painful lesson to a generation of investors. This doesn't just happen on a massive, market-wide scale. We see it with individual stocks all the time. A meme stock gets pumped up on social media, soaring thousands of % in a matter of days. It has nothing to do with the company's performance and everything to do with speculative frenzy. For a while, it looks like gravity has been suspended. But then, the early buyers start to sell, the momentum shifts, and the price comes crashing back down, often leaving latecomers with huge losses. The balloon pops. Conversely, market gravity also works on the downside. Sometimes, a great company with solid fundamentals gets unfairly punished. A bad news cycle, a temporary industry headwind, or just general market panic can push its stock price far below its intrinsic value. The balloon is now being held underwater, but if the business itself remains strong, profitable, and well-managed, what happens? Smart, patient investors recognize the bargain. They see that the market has overreacted. They start buying, and slowly but surely, the stock price rises back up to reflect its true worth. The balloon returns to the surface. This is the essence of value investing, the strategy championed by legends like Benjamin Graham and Warren Buffett. They spend their careers looking for these opportunities, great companies on sale. So, how can you, as an investor, use this concept of market gravity to your advantage? First, you have to do your homework. Don't just buy a stock because it's going up or because everyone is talking about it. Investigate the underlying business. What does the company do? How does it make money? Is it profitable? Does it have a lot of debt? Who are its competitors? This is what we call fundamental analysis. You are trying to estimate the company's center of gravity. Second, cultivate patience. The market can stay irrational longer than you can stay solvent, as the saying goes. A stock's price might stay detached from its fundamental value for months or even years. Your job is not to predict the exact moment it will correct, but to be confident in your assessment of its true worth. If you've bought a wonderful company at a fair price, you can afford to wait for the market to recognize its value. If you're watching a wildly overvalued stock from the sidelines, you can have the patience to wait for gravity to bring it back to a more sensible entry point. Third, and this is crucial, focus on margin of safety. This is a core tenet of value investing. It means buying a stock for significantly less than your estimation of its intrinsic value. If you believe a company is worth $100 per share, you don't buy it at $95. You wait until you can buy it at $70 or $60. This gap between the price and the value is your margin of safety. It protects you if your analysis is a bit off, and it provides the potential for greater returns when the price eventually rises to meet its value. It's like having a safety net below your tightrope. Let's look at a modern example. During the tech boom of 2020 and 2021, we saw many high-growth, non-profitable tech companies reach astronomical valuations. The narrative was that growth was all that mattered, and profits would come later. The balloons were flying high, but then 2020 happened. With rising interest rates and economic uncertainty, the market's mood shifted. Investors suddenly cared about profitability and cash flow again. They wanted substance, not just stories. And what happened? Many of those high-flying stocks came down 70, 80, or even 90%. Gravity reasserted itself, swiftly and without mercy. The investors who had paid attention to fundamentals and avoided these overvalued names were able to protect their capital. Understanding market gravity is about shifting your mindset from a speculator to a business owner. When you buy a stock, you're not just buying a ticker symbol that you hope goes up. You are buying a fractional ownership stake in a real business. Would you buy a whole coffee shop for 100 times what it earns in a year? Probably not. So why would you do that with a stock? Thinking like an owner forces you to focus on the long-term health and profitability of the business, not the short-term whims of the market. This principle is your best defense against hype and your greatest ally in building long-term wealth. It keeps you grounded when everyone else is getting carried away with euphoria, and it gives you courage when everyone else is panicking. It reminds you that, in the end, fundamentals matter. Earnings matter. Cash flow matters. Value matters. The market might be a voting machine in the short run, driven by popularity and sentiment. But in the long run, it is a weighing machine, and it weighs the actual substance of a business. And no matter how high a balloon flies, it is forever tethered to the weight on the ground. Gravity always, always wins. Thank you so much for watching today. I hope this gives you a new lens through which to view the markets. If you found this helpful, please hit that like button and consider subscribing for more content on smart, long-term investing. Let me know in the comments what you think about market gravity. Have you ever seen it in action? I'd love to hear your stories. Until next time, invest wisely.